Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with us. It's Friday, and we are talking markets with Mr. Jim Welsh of Macro Tides. Good to see you, Jim.
Well, I'm glad you got that Mr. in there.
Yeah, well, when people call you Mr., you're like, hey, wait, is it
getting older? And as this shows, a lot of people call me Mr. these days.
Well, Jim, Mr. Welsh, let's talk a little bit about. Well, let's start off with the inflation data. How did you read this month's inflation read, both on CPI and PPI? And did it change your expectations about what the Fed's going to do moving forward?
No, not at all. Again, my expectation has been is that we are going to see inflation continue to drop, especially because the takeaway values in the next 2 months, for instance, are really pretty high. So, a few months ago, I was saying, hey, the CPI is going to be under 4%, may get under 3.5% by the time we get to June CPI in July. So I don't think that changes the Fed dynamic for two reasons. One is I think the labor market is more important to the Fed than the inflation data at this point in time. And with the unemployment rate at a 53 or 54-year low, that just means that there's upward pressure on wages with the labor market remaining so tight. And the second thing is, for several months, starting with the December meeting, they identified 5.1% as being kind of like, this is where we want to get to. And with the last increase last week, they're at 5.12, the split between 5 to 5.25. So I think for most of the Fed governors, they're at where they think they need to be. And lastly, as we've talked many times, they don't want to do the mistakes of the 1970s, where they just kept hiking into a recession, which forced them to reverse. The idea here was, let's get it up so that it's snug enough, slowly tightening credit conditions so that the economy does not immediately drop into a recession and force us to reverse course. So for me, I think the Fed is at the pause level, but we're going to continue to hear speeches by some governors saying, well, we may have to go higher. They've got to talk that talk. And then you're going to hear some of the doves like Goolsbee and probably one or two others talking about, well, I think it's maybe time to assess. So for the first time in over a year, we're going to see some divergence in the content of speeches and interviews by FOMC members. I mean, for most of the last year, Blake, we've talked about this. They've all been on the same page, delivering the same message. Remember, last spring it was, well, we're going to get to neutral, which was 2.5. And then as inflation kept ramping up, we got to get to slightly restrictive, which is what Powell kind of, surprised the markets with the Jackson Hole speech in late August. So anyway, for all those reasons, I think the odds are the Fed is going to hit the pause button. They just don't want to convey that yet to the markets. And, legitimately, they are data dependent and they want to see more numbers.
So speaking of data dependent, talking about the labor market, we saw an unexpected tick higher in unemployment claims this week. Does that worry you at all that employment
Not at all.
To slow down? Okay.
Well, no, again, my expectation, again, we talked about this. The labor market is the last thing to move in every business cycle.
Of course.
Employees don't want to let people go, good workers go. They'll cut back hours. They'll try to do other things before they actually have to do that. And given the last 18 months, most employers struggle to find good people. That inclination, I think, is going to be stronger. So when I hear people saying, well, we haven't had a recession and the Fed's raised 500 bips and I think we're not going to have a recession because look at the labor market. Hello, that's always the last thing to go. So I think the definitive signs of, and things like the unemployment claims are on the leading edge. Things like the quits rate coming down, the jolts coming down. Hours worked has already come down. The number of temporary workers coming down. So all the leading indicators, Blake, are already pointing in the direction that we are going to see more softening in the employment market. But this is what the Fed wants and feels it needs to see in order to really get inflation down to their 2% target.
And do you think? And let me ask: do you think they're going to be successful?
We really don't know. I don't know. I mean, I think are they going to get it down to 3%, give or take? Yes. Then it comes down to how much economic weakness shows up. I think the risk of a hard landing next year, has been ramping higher with tightening of lending standards and so forth. And so at some point in time, it'll come as a trade-off for the Fed. Do we allow unemployment rate to keep climbing? Because once it starts going up, consumers stop spending as much because they get worried. People get laid off. They cut back. They have to. So typically, once the employment rate starts ticking higher, it continues to tick higher. So the Fed will be in the position of, do we want, no matter, even if they cut rates immediately, unemployment rate's going to tick higher for a period of time. So to me, it's a trade-off between how much pain do we want to cause via higher unemployment rates versus getting the inflation rate down closer to 2%. And, I think the majority of people think they're going to cave. I think that, based on what Powell has said, and a number of these folks, again, lessons of the 1970s, easing prematurely would be the bigger mistake. That Powell has said that repeatedly. So what they're looking at is, okay, we got to have to cause some pain to get our end result. And if we back off too soon, the risk is like in the 1970s. Yeah, inflation came down during the recession, but didn't come all the way down. And then in the next business expansion, ramped up quickly into a higher level. So again, we don't know, they don't know, but I think that's the framework that they're going to be operating under.
Well, okay, and you'd mentioned something last week, and I want to share it with everybody. Talked a lot about lending standards and how important this was going to be to the Fed. So, what are your thoughts here regarding lending standards?
Well, I started writing about this last November because lending standards started to go up last year, and in January and February, again, because we got the fourth quarter. It's the Senior Loan Officer Opinion Survey. The nickname is SLOOS. Came out for the fourth quarter in early February, and it got up to 43%. And so in the first quarter, it ticked higher from 43 to 47%. And now all of a sudden, people are finally discovered lending standards, right? And so it
was a big topic of discussion this week. The SLOOS.
Yeah. But some people's reaction, well, it didn't go up that much. I mean, you had this banking thing going on. It didn't go up that much. It's like, folks, anytime it's gone above 20%, as you can see on this chart, a recession has taken place. So the last 35 years, there's been a recession every time lending standards exceeded 20%. Why? Because that means less liquidity is flowing into the economy. Companies can't borrow as much money. Lending limits, credit limits get taken down. The spread. So the Fed's just raised rates by 5%. Well, what banks do when they raise lending standards is, we're going to tack on another 1% or 2% above prime to your loan. We'll give you the money, but you're going to pay up. So that's why lending standards is so significant, because it isn't just the price of money, it's the availability of money. And that's why it is such an important thing to watch when lending standards get ramped up. So to me, the die has already been cast. Historically, there's a lag of about 9 months from when lending standards really get tight. And again, I'm going to set the clock as of the end of last year. So we're talking about the third quarter. So again, these are one of the reasons why I've consistently been saying after mid-year is when the risk of more slowing, at least 1 quarter of GDP being negative before the end of this year, and the lending standards are part of that equation. So we've already crossed the Maginot line in terms of the impact on the economy. And, the fact that it went from only to 47%, guess what? When the economy slows down and it really shows that it's slowing, what do you think they're going to do with lending standards? They're going to raise them even more. So that's, it's just the way it always works, Blake. I mean, these patterns are very consistent to the way how the economy functions.
That makes sense. Well, you talked about loan demand here. Let's discuss it. How's that been affected?
Well, take a look. Historically, when you see when banks tight lending standards, it's almost like by definition you're going to see a drop in lending because they're not lending as much. Yeah. But at some point in time, businesses become more cautious. Maybe we're not going to do that investment in increased capacity. Let's cut back on borrowing. The cost of money is going up. Hey, let's make do with what we have. So again, if you go back, unfortunately, this where you can barely see, there's a shaded area on those downward spikes where recessions took place. So you can see in 2001, obviously 2008 and 9, 1990 is maybe not even on this chart, but it happened back then too.
Yeah. Oh, whoops.
So my point being is this is another signal that companies are starting to pull back. And if they spend less money, that's obviously going to weaken economic growth.
So the next chart you brought was this is another lending standards chart. Oh no, that is the wrong one. Correct. Excuse me. Sorry, that was the same one there. Let me get rid of that.
That was the first one. We're going back. It's Friday. You deserve some.
Yeah, I did. You know, I'm looking around and let me make sure I got that correct chart there, Jim.
Yeah. There was a third chart, but that's okay, and I can't remember what it was. It was regarding earnings, I think. Again, historically, when credit standards are tightened,
yes,
the economy slows down. Guess what happens to earnings, folks? They weaken. And so, again, all this is what's coming, but I think it's more of a second half of this year's story. So this is the labor market. The NAIRU stands for non-accelerating inflation rate of unemployment. All right, only economists come up with this. The red line shows the Fed's estimate of the balance, equilibrium between too much demand or just the right amount of workers available for work. And what we can see is historically, when this gets below the red line, is when the Fed starts raising rates, because the idea being is, hey, if the labor market gets too tight, wages are going to go up, cost of goods starts to go up, it starts to get embedded. So from the Fed's perspective, there's just no way they're going to be cutting rates in the second half of this year, as the Fed funds futures are looking for 2 rate cuts, which is to me incomprehensible. Unless the economy is really going into the tank, the Fed isn't going to cut. Well, when the economy goes into the tank, usually the stock market doesn't deal with that initially very well. So this is just another indicator that the Fed looks at in terms of a sign that the labor market is too tight. And what we can see is, prior to every recession, look at what happens to the unemployment rate. It goes up the most after the recession begins. Goes back to the point I made earlier. Once the unemployment rate starts ratcheting higher, it feeds on itself, which causes even more economic weakness. And, this is a pattern going back 50 years. You want to bet against that?
Yeah, right. Exactly. So what does that mean? What does that mean for the dollar? Because it looks like the dollar's starting to perk up a little bit today. And we're finally, looks like we're holding this support. You've been calling for it. You're like, I'm not going to get bearish until you get below there. It's starting to peak a little bit higher right now. Is that a function of the dollar? Or is that a function of the ECB and the Bank of England?
Well, what's interesting is both of them increased rates. Both banks indicated that, hey, you know what? More rate increases are coming. So here we have a thing where a pause is more likely from the Fed at any time than, in the last 14 months. And so despite these indications that ECB and the Bank of England are going to raise rates more, the dollar firmed up. And today, the 102.25, a close above that, to me is significant. There was an intraday spike, I think, up to 102.40, but you had 2 other spikes up to 102.23, 22. So to me, today's strength looks like the beginning of a breakout. And from a pattern standpoint, what I've been saying is you had the low just under 101 back in whenever that was. I can't read the chart, late January. And the rally up to 105.88 was wave A. This pullback was a B wave, kind of a double bottom. And I think there's the potential that wave C will take the dollar above the 105.88 level. Again, so if the dollar's weak.
Okay.
Go ahead.
No, I was going to say, you think that wave C could actually surpass this level here?
It's supposed to. Okay. At least get up to challenge it, okay?
Yeah.
And again, think about the dynamics here. Wave A topped right as the regional banking crisis began to become, big deal. And the assumption, oh my God, the Fed's going to cut rates. They're not going to keep raising, they're going to cut rates. And so the Fed funds futures are still looking for 2 rate cuts in the second part of this year. I don't think the Fed is going to do that. So to me, that is why I have felt that, besides the technical pattern, that when people start to realize that the Fed isn't going to be cutting rates and they're going to signal that. I mean, I think the messaging from FOMC members are, we're going to hold it higher for longer. There's going to be some that say, we may go a little bit higher, and there's going to be some that say, no, I think we should hold here. But I think almost universally they're going to say, yeah, we're here. We're wherever the terminal rate is, we're going to hold it for longer. And I think that provides a tailwind for the dollar.
Right. Okay, that makes sense. So what does that mean for gold? Because gold is, I know it's not drawn here. I'm going to just try to draw it. There's like a nice little channel.
Nicely done.
That we've been following, and we're getting close to that channel support. So what happens with gold?
I think it goes down. I think you can count 5 waves up from last September. So longer term, to me, that's a big bullish signal that wave 1 of the next advancing wave to all-time highs, is over. Well, then you get a wave 2 pullback. Now it's just a question of how deep of a pullback. And I think 1885-ish is a 382 pullback. And then wave 4 of lesser degree is around 1810. So if the dollar does indeed rally up toward and above 105.88, that I think is negative for gold. The other thing is, I think there's a moment coming where the stock market's going to have a period of, significant weakness. The Fed isn't cutting rates at the first sign that the economy is really slowing. And Wall Street still thinks earnings are going to be up 11% this year, Blake. It ain't going to happen. So at some point in time, they're going to be cutting rates at the same time the Fed is not going to be coming to the rescue.
Yeah.
And I think that creates weakness. And what I've seen repeatedly is you see, a market that's been strong, and then here's this other market that gets really weak. So in this case, the stock market, if it really starts to weaken and get beat up, all of a sudden fund managers decide, what's up? What in my portfolio can I sell? Because I don't want to sell this stock because it's down 20%. What can I sell that's up? And so in a sense, you get a liquidity event where something like gold, which has been doing well, becomes a target just for people to raise some cash so they don't have to sell something else. That, I think, is, again, how do you get down to 1810? If you see a fairly significant move down in the stock market, that could be a factor in driving, in addition to the dollar rallying, driving gold down deeper. But again, the bigger picture is once this correction is over, I think gold is going to new all-time highs.
Okay,
so,
well,
it's a question of trying to find the place to buy. The end of wave 2. That's the mission here.
All right. So the wave 2 is going to be somewhere down here, somewhere down here. And it's such a big level of resistance. It's like a battering ram trying to knock down a castle, gate.
Yep.
And it's gonna take a few times before we get through it, but it does seem like we will eventually make it. The question here is in the bond market. You've been calling for a higher TLT move.
Yep.
And are you still looking for that?
Yeah. Basically, the pattern to me is from the low last October, big rally up to 109.68 for wave A. I thought we completed an ABC when the S&P or the TLT got down to 98.88 or whatever that is.
Yeah.
And we're off to the races. As this thing is stretched out, to me, the pattern potentially could be a triangle for wave B. The red B, we have A down, B up, C down, D up, and wave E ending maybe at the 102.84. I mean, triangles are a pain because they just keep chopping sideways. But ultimately, I think this is going to resolve with a breakout to the upside. The wave A was about 16 points or so, 17 points. And if we add 17 points to 98.88, that's where you get the 115 to 117 target. So again, I think we're going to see the economy slow materially. Inflation is going to continue to come down. The regional banking crisis isn't going. In other words, the deposit outflow isn't going away. They may come back. They may increase deposit insurance and so forth, which would be helpful. But the fundamental problem is that most banks are paying 50 basis points on people's savings accounts at a bank when you can get 4.5 to 5. So that gap, and you have Apple coming in with their, hey, we'll give you 4.15%. Well, a lot of people have an Apple phone, and I'm sure Apple's doing some marketing, educating people. Hey, on your money you could be getting this. So to me, that deposit outflow, Blake, is just going to continue. Whether they do the increase the deposit insurance from 250,000 to some number. I think they should do that personally, especially on payroll accounts where businesses need to hold more than 250,000 to meet payroll.
Yeah.
They should be protected to 1 million, to whatever it is. That's a whole different function, So, but anyway, to me, the chart pattern all add up to, I think, a rally in TLT up to 115 to 117.
Makes sense. Okay, so what does that mean for stocks? Because the stock market, you've been calling for a new high,
one
before
more pop
lower, but today obviously the market's down a little bit. Do you still think it's possible we get above these highs?
I do, as long as we stay above that 4,048. That would call that into question. Obviously, the double low there. On April 4th, the S&P got to 4133. We've gone nowhere in 5 weeks.
Yeah.
A lot of stopping around, just not going anywhere. And I think you've got opposing forces with, is the Fed going to keep going? Are they going to pause? At the same time, is the economy going into recession or not? Now the debt ceiling thing is becoming a big issue. So to me, I could see I think I'm like everyone else. There's no way these these politicians, our leaders, will screw this up so bad. But you know what? In the world that we live in, it's possible that they want to take one step into the abyss before they, oh my God, okay? And what would cause that? Markets getting really upset. It's like, oh, I guess maybe we better do something. We have to do something.
Yeah.
So that's a wild card. If the market continues to hold up and they do come to some resolution, that's how you can get a spike up to 42.50, up towards 43.25. Which was the August high. And you've got a lot of shorts. Some people are protecting themselves. What if this thing really goes bad? So that would be a news event that could cause a lot of short covering, a quick pop. To me, that pop is to sell into and go short.
Yeah,
once that's behind us, the economic fundamentals are the next, lead story.
Yeah, and that's true, a true statement, Jim. And I was actually just discussing with some other traders today in our community. It's like if you're not curing the disease, it's still there, right? It's just a short-term fix. It's not something that our politicians, our leadership here in the United States is taking on head on. It's just kicking that can, once again, the proverbial kicking the can down the road. And you make a great point. I mean, it doesn't change the fact that we are dealing with a slowing economy, and we have all the multiple issues you just talked about are still coming our way.
Yeah, so it's kind of like you got this distraction in the short run, fixation on the debt ceiling, which is understandable. Once that's gone, then the attention goes back to the fundamentals. I guess I'm in the camp that I think the Republicans should pass a debt ceiling. At the same time, they need to do a better job of communicating. There's $31 trillion worth of debt. The interest expense is going from $350 billion a year. In the next year, it's going to be $1 trillion.
Yeah.
Something needs to, spending has been growing faster than the economy, which is why debt as a percentage GDP keeps getting bigger and bigger and bigger. It's like, a cancer. For a while, you don't even know it's there. And then for a while, it's like, okay, I'm getting treatment, and maybe you go into remission because the Fed cuts rates to 0. And then the cows come home to roost, or whoever it is that does the roosting. And so to me, there's a serious problem, but, it's just really unfortunate. But I like the idea of saying to people, you know what, spending should be held to a certain percentage. If we ever want to get control, government spending needs to grow more slowly than GDP.
Yeah.
That's the only way you can shrink this debt problem. Now, the downside is, guess what? You're going to get less GDP growth.
Yeah, that's true. That's a great point. Speaking of growth, next week we don't have a whole lot of economic data next week, but we do have retail sales. The prior month we saw a really big, kind of hit to the consumer. How do you expect the consumer to hold up in this environment? Do you think that the American consumer is going to continue to buckle?
The buckle is coming. Let me put it that way. San Francisco Fed just did a big analysis of excess savings and so forth. And their guess is that in the first quarter, consumers were spending about 80 billion of the excess savings, and their best estimate, and all these are guesses, is about 500 billion of the 2 trillion plus is left. So you take, 80 billion times 6 months, get you down to where you're hitting the end zone, so by the end of this year, more and more people, obviously. So to me, that has been the buffer and why the economy has surprised people in holding up. It's something I've talked about repeatedly, last year when everybody was saying, oh my God, a recession. No, we're not having a recession. The labor market is slowly, weakening. So to me, this is a process. It just takes time. Lending standards going up, all right? It's not a light switch. So that if I've got a loan with my bank and he just increased his lending standards, but my loan doesn't come due for 6 months, I'm not going to face the brunt and have to deal with a higher spread or not getting as much money for 6 months. So that's why the increase in lending standards takes time to filter through and have an impact on the economy, because the loans don't come due all just because they raised lending standards in the first quarter. So it's a progression. And the pool savings, unemployment at a 54-year low, minimum wage going up in 26 states, Social Security doing an 8.7%. All these things were injected money into consumers' pockets, more money. But slowly but surely, I think that gets whittled down. And why I've been saying, the second half of this year is where we're likely to see more, pronounced weakness in the economy. So in the very near term, I think on balance, consumer spending, is okay. But it's going to continue to slow in coming months until we really start to see unemployment tick higher before the end of this year. That's when you see a much bigger retrenchment in spending.
All right, Jim. Well, thank you every week for taking us through and guiding us through the markets and your views on the markets. Really appreciate you. What's the best way to follow your work at Macro Tides?
Macrotides.com, or send me an email, Jim Welsh, macro@gmail, and I'll send you the March Macro Tides, which kind of went into great detail, the 6 dominoes of recession. And so far, 4 of the 6 have already toppled.
Well, folks at home, please jump in the comments. I know some of you did last week, Jim. I'm not sure if you saw them, but make sure you jump in the comments. And if you have anything that you want to add or ask Jim, that's a great place to do it. Also, I hope you're taking advantage of getting his most recent reports. So make sure you email Jim when you get an opportunity. Hey, Jim, thank you so much for taking us through this week. We'll see you next week, and have a great weekend.
Thanks, Blake. Always great to chat.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.